Hello, everyone. Thank you so much for joining me tonight. My name is Michael Petraka, as everyone knows. I am the owner and operator of HAP Financial Group. Tonight's presentation, we're going to do my semi-annual review of the markets and the economy. Feel free during the presentation to raise your hand by hitting the bottom on your screen in terms of the Zoom icon that just has a little bit of a hand, or feel free to write in the chat box, and I am be happy to address any questions during the presentation or at the end. So with no further ado, let me share my screen. As always, I like to start out with the US stock market. So what we're looking at right here is the S&P 500, which is simply the 500 largest companies in the US over the last 25 years. So one very important thing to factor in is, sadly, when people just look at this and they say, oh, stocks are good, the economy is good, everything's kind of great. Sure, of course, that does add up. But what I would always recommend people do to help determine if the stock market is cheap or expensive is understand the multiple that we are all paying to own stocks at these levels. And so the multiple I'm referring to is this equation right here. So if we look on the top right, we kind of have the PE multiple, which is just the price of the market divided by what companies are earnings. And that tells you the multiple we're currently paying to own stocks. So as we sit here today, to own part of the stock market, we're paying 21 times earnings. Well, what does that really mean? And I'm sure all of you have heard the example I always give. You could do this with rental real estate as well. Let's say you were going to buy my office from me, and I tell you that normally rents are 10 grand a year. So if you're going to buy it, what are you going to do? You're going to check the other 200 units in this complex to see what they're trading for. What's the multiple that we have to pay to buy it? So you check all the places, and looks like they're all trading at about 15 times rent or 15 times earnings. So if the rent is 10 grand times 15, that means you should be able to buy it from me on this Garden Variety Wednesday at 150 grand. Now, we all know markets aren't always even keel. There's good times, there's fear in the market, there's greed in the market. Sometimes news and rumors can push it in one way or the other. So let's say you come to me and say, all right, I'm going to buy it from you for 150 grand, and I'll tell you I'm going to think about it. Now, we're going to pick up the newspaper tomorrow, and let's say we see a headline that there's going to be a train station from Fairfield, New Jersey, right to New York City. Well, we both know that rumor is going to make this land worth more money. So although my rent has not moved, it stayed at 10 grand, I'm now going to ask $200,000 instead of 150,000. So that multiple just went from 15 times to 20 times. So we can see in the S&P 500 here in the last 25 years, there's periods of time where there was a lot of optimism in the market. So a perfect example is the tech bubble of 2000. So here we see in March of 2000, that multiple got as high as 25. Now we can go back the last 120 years of history in terms of US stocks. That's the highest it was ever. So when we're paying such a high multiple, really everything has to go unbelievably beautiful in terms of the earnings to justify that type of multiple. Now, sadly, for everyone's sake, the tech bubble had burst. So if you paid 25 times earnings, you went through about 10 years where stocks made no money whatsoever. So a very good concept to understand is typically the higher multiple you're paying, the more you've probably borrowed from future returns and got it up front. So as we sit here today, we're trading at 21 times earnings. Like I said, in the last 120 years, that's certainly on the expensive side. Now, let's say we have the luxury of buying my office right after some bad news. Let's say there's a flood in Fairfield, New Jersey. No one wants to move here. Think of like the flood in the financial market of the 2008 financial crisis. Stocks were trading in March of 2009 at a multiple of 10. Now, just based on my example, 10 is really, really cheap. Now, it's cheap because of bad stuff's going on, but if we know bad stuff doesn't stay forever and good stuff doesn't stay forever, probably things regress back to averages. So if you had the opportunity to buy stocks at a 10 times multiple back in 2009, You had one of the longest and biggest rallies in the history of this country. You enjoyed a nice 400 plus rate of return over the next roughly 10 to 12 years. So again, one of the first things we do when we're trying to gauge how the stock market is doing or how much we have to pay to own it is we want to look at that multiple that we're currently paying. Now, once we know that number, we can go back in history and say, well, what does that mean going forward? So if we're trading at 21 times earnings, if we're looking at the chart on the left, and we say, well, what does the next 1 year rate of return look like? Unbelievably unpredictable. So if you ever go on CNBC and you hear some talking head and say, well, considering where stocks are now, I think the market's going to go up 10%. He and everyone else is kind of full of it. Markets are very unpredictable in the short run. 6 months, 1 year, you have no idea where it's going to go. The longer time horizon you have to work with, a 5 year and 10 years, becomes much more of a predictable reality. So I almost kind of hate when people say, oh, it's like a casino. Not really. And if it is, it's almost as if you're the house. What the house knows is the longer you play, the more predictable that they're going to win. Same thing in the stock market. If we tell me that this is where we are trading in terms of a multiple, and we're looking, well, what does the next 5 or 10 years look like? Instead of a range of 20% up to 20% down, even this 5 year multiple, now we've narrowed to a much more narrow of a range. Maybe we're looking at upside of 10 and downside of, let's say, a break-even type scenario. So as we're trading here now at 21, you're probably looking at mid-single digits in terms of rate of return for US stocks going forward. Now that's relatively understandable. Going back to this last slide, really since the 2009 financial crisis, yes, of course we had the COVID scenario, but that was a very short-lived recession. And then we had the 2022 was painful, but in hindsight, you had 2 market cycles in 4 years. That's an unbelievably short period of time. Normal market cycles are 6 to 7 years. So besides those years where, more or less you held your breath for a few months and markets turned and we back to all-time highs. So it's pretty understandable that we're looking at future rates of returns for US stocks to be a little bit muted because we've had a pretty good run over the last few years. Now, within a stock market, if we were to put them in 2 broad categories, there's what's called value stocks and what's called growth stocks. So let's say you were one of the construction companies out there. I don't want to name any names. Construction company A, and you're looking at it and it's trading at 12 times multiple or 12 times earnings. And then you look at their direct competitor and you see that they're trading at 16 times as their multiple. Well, the one trading at 12 is cheap compared to where it probably should be valued at. So maybe the stock's trading at $30 and you think fair value compared to their peers is $40. That's what's called a value stock. It's cheap compared to where you think it should be worth. A growth stock, a little bit harder to predict. These are companies that are growing very fast. Maybe their top line revenue is going up. Maybe they don't have any net income yet, but you believe the story's great. So a good example of this would be the tech bubble of the late 90s into 2000. These companies didn't make any money yet, but the internet and computers and technology was so much of a great story, stocks got crazy out of hand. So those are situations of growth. As we sit here today, and really for the last 10 to 15 years, growth has done very well. Hence, values got even cheaper. So if we look at this chart on the left, this is probably a good time when you compare it to history to have somewhat of a value tilt in the portfolio, which I do for most of the portfolios. Now, I always like to have this slide in my presentation. This is really based on, or the reason I put it here is emotions. Stocks are very unpredictable. Like I just said before, no one really knows 6 months out, 3 months out, 1 year where it's going to be. Now, the markets do a fantastic job of weeding out the people that run a little bit scared, run a little bit nervous. So what you're looking at right here is the gray is calendar year rates of returns, and the red is during that year, what was the biggest decline we saw? So let's say a year looks like 2012, a year that markets finished up 13, but at some point in that year, markets went down 10%. So there is always going to be something that scares you, whether oil spikes, war, interest rate movements, and 5-10% can be quick. Now, this is a reality that, don't get me wrong, we're all happy to be here. Right now, most of my financial plans, as I spoke to all the people on the call, are looking great. Why? Because investments are up, bonds are paying nice, healthy interest rates, everyone's accounts are up, so everyone's financial plans up. So everyone's pretty much on this call is dealing with all-time highs in terms of their net worth. Now, what that also means, let's say we have a net worth in the market of $1 million. Well, now, what is not so much of a rare situation, markets fluctuate 10%. Now we're seeing 10% moves on $1 million. That's 100 grand that could evaporate in 3 weeks. So especially as we're seeing our accounts get to all-time highs, we have to stay calm in these markets because we're dealing with bigger and bigger numbers. So it definitely gives you a nice little gut check, but just know markets reward you for staying calm when things are getting hectic. To touch upon the economy is not, it's a little bit of a Goldilocks, and it's not crazy good, and it's not in a bad shape. It's in relatively okay shape. So what I always call these 4 items here is kind of the 4 horsemen of a possible recession. So good example is the 2007, 2008 financial crisis. And what you're seeing here is housing inventory. So this was a situation where it got very high and the bubble had burst, sending us into some very painful time. If you notice, most of the things on this chart, which again, 1 is housing, 2 is vehicle sales, 3 business investments, and 4 is inventory, nothing is crazy out of hand. If you're worried about a recession or a bubble bursting, and these are kind of 4 big categories that really can send you into recession, none of these are too far out of whack, which is a good sign. I always give the example, like if you're jumping out of a window, was a really big difference if you're jumping out of the 1st floor or the 10th floor. So, you use the example of the 10th floor maybe being this 2008 financial crisis where housing starts went through the roof. Nothing is at that level. Not crazy good, not crazy bad, kind of right in the middle, in my opinion. Now, this is the scenario where we never know when the music's going to stop. So what we're looking at right here is our 2024 federal budget for the US government. Now, what this big dotted line white area represent is kind of the deficit. It's almost a $2 trillion deficit, and we're pretty close to, don't quote me, right around maybe about 35 trillion as our national debt. These are very scary numbers. And on top of this, now think of all the people who had a line of credit on their house for the last 10 years. It wasn't a big deal. If you were carrying a 100 grand line of credit and it was costing you 2-3%, all right, maybe it's costing you 2,500. Well, now that all has been refinanced or all those interest rates recalibrated. So instead of spending 3% on the debt, now we have to spend 9% on our debt. Now it's much more painful. Same thing for the federal government. We were borrowing for the last 10-15 years at 1-2%. Now we need to borrow 4 to 5 trillion. I'm sorry, 4 to 5%, utilizing trillions of dollars as the number behind it. That is obviously not a sustainable path. What you're doing is borrowing from the future, and what you're doing is borrowing from future growth. So I give the example of an individual. Let's say an individual makes $100,000 a year. They could spend $100,000 a year putting taxes aside. Now, let's say that person has $5,000 of credit card debt that they have to pay interest on. Well, the more interest they have to pay, the less money they have to spend. So a scary figure that came out recently is, we're approaching the period where we're spending more on interest payments than we are to defend the country. That's obviously not sustainable. Now, you could have found someone similar to myself 40 years ago that says this exact same thing, that this is not sustainable, that that's going to be the problem. So that's why I started this, where we never know when the music's going to stop. This can come to a painful reality tomorrow. It could come to a painful reality 100 years ago. To give us a little bit of peace of mind on this is, part of the reason we're able to borrow as much as we do is we're the reserve currency of the world. That's not going to change anytime soon. Everyone hears that we're being replaced and China's going to take over and we're losing our place in the world. In the last 5 years, compared to the other developed countries coming out of this COVID experience, we've more or less lapped the field. We have substantially better growth and substantially less inflation than your other large developed countries. And China, coming out of COVID, they had the lockdowns much longer, I think had a big psychological change on their people, and they really haven't been able to shake it. So where everyone thought maybe in 10 years China was going to take over, maybe it's 30, 40, 50, 60, 70 years when their economy gets past us or ever. Don't get me wrong, unbelievably painful for the experience of the everyday American that we've dealt with in this country. If you didn't own a home and you didn't see your house appreciate in value and you were renting and your rent price went through the roof, very painful. Food prices going up, very painful. Auto insurance going up, very painful. I completely understand. But in terms of the national debt, in terms of how long could we sustain it, really the last 5 years has probably almost helped our cause, because if we're not the power and we can't borrow, that means someone else has replaced us. And really no one else is anywhere near capable of doing that anytime soon. Hopefully that's not a sign for the Republicans and Democrats to continue to spend willy-nilly. Eventually it does bite us, but the big question is nobody knows the when. Now, we were just talking about the government's debt, bringing it onto the everyday consumer. So you're starting to see a tale of two worlds. So in the top right here is how household debt service. So in terms of your income, what percentage has to service debt? Over the last 40 years, we're actually at a pretty good pace. Now, the bottom right sends a different signal. So if we're at a good pace and the debt we have to service is relatively low compared to our income, why are we seeing situations where auto loans are going through the roof, credit cards are starting to go through the roof? You're starting to see a bigger and bigger divide, in my opinion, of the winners and losers within an economy. So if you were fortunate enough to, let's say, buy a home 5 years ago, you locked yourself into a 3% mortgage. Let's say you don't carry credit card debt. This has been a great period of time. Your wealth has ballooned up. Your portfolios have gone through the roof. Your real estate values have gone through the roof, and your debt has been fixed at extremely low rates compared to today. Now, going back to the person who's not so fortunate, again, if you don't own that home, you didn't enjoy any appreciation, you just saw your rent prices go through the roof, you didn't see your wages keep up with inflation, and you saw your costs balloon up. So more and more people are being forced to go on credit cards, more and more people are being forced to spread themselves thinner and thinner. And you're kind of seeing this in kind of the national savings rate. So this is roughly over the last 65 years, the average savings rate in the country. Now we're getting to a pretty low point. Now, again, I think the people towards the top, maybe your top 20%, this has been great, but this has been unbelievably painful for everyone else. So all those people had stimulus checks coming out of COVID. This is top right corner, the shaded blue area, have kind of burned off all the extra kind of government payments, and now credit cards are going up, delinquencies are going up, savings rates are going down. Very painful time. I don't think a lot of these graphs really illustrate some of the pain underneath the surface. A lot of these things, like I'm saying, the economy is going okay, everything's going okay, but I think it's more of a situation where some people are doing great and some people, it's really painful. And that's probably why you're seeing a lot of frustration. Politics is going to be a big story over the next 6 months. There's a lot of pain to go around in today's world. Now, what you're looking at right here, this is the Consumer Confidence Index. This gives you a pretty good idea of when you want to invest. And it's pretty much the exact opposite of how people feel. So, perfect example, November of 2008, we just went through Lehman crisis going under, the whole world's collapsing. No one knows if the economy is going to hold on. There's a lot of fear in the market. Of course, this was a fantastic time to buy. June of 2022, just going back a couple years ago, inflation's through the roof. We can't come close to getting it back into the genie, back into the bottle. We're raising interest rates like crazy. Food prices are through the roof. There's a lot of fear. There's a lot of panic. Markets drop 25%. Fantastic time to buy. So long story short, the worst kind of the confidence that's out there, that's typically a leading indicator of a good time to buy. Now today, this is rather a bit of an anomaly. We're sitting here with unemployment at 4% and has hovered at all-time lows for the last 100 years. We have stocks at all-time highs. We now have bonds and CDs again paying 5-6%. If you locked yourself into a fixed rate mortgage, where the good percentage of the country did, your debt is at a very reasonable pace, and we're feeling gloomy as some of the worst times in the history of this country. So that's a pretty big anomaly when you look back at history. Again, in my eye, to try to think of all the different categories of stuff, you get nervous if things are signaling bubble, thinking of fearful times. Nothing is overly bubbly. So confidence is low, which normally means things are pretty good. I went over the kind of 4 horsemen. None of those are really in bubble territory. Companies' profits were signaling at all-time high. Margins are pretty good. The economy overall is doing okay. Now, in saying that, you're starting to see the beginnings of a little bit of a slowdown. You're starting to see unemployment numbers tick up. That doesn't mean panic. That doesn't mean run for the hills, but that's somewhere still in the gray of just kind of okay getting through. Now, a big thing that will play into this will be interest rates, which I believe are coming up in a few slides. Now, I just mentioned the jobs number and unemployment. We had a rather incredible scenario going back a couple years ago. So, even if you go into the local 7-Eleven, I remember in 2022, you saw a help wanted sign, help pay student loans, sign on bonus, raises within 6 months, because there was a tremendous imbalance in the employment world. So in March of 2022, you had 12 million job posting for 6 million people, for 6 million unemployed people. That was 2 to 1. It's never been that high in history. So as this economy has slowed, really a lot of it is companies that were looking to hire have taken down the hire sign off the door. So as we sit here today, we're getting pretty close to back to a 1-to-1 scenario. Again, long term, that's still really good, but short-term speaking, we're starting to get back to more of an equilibrium. We were touching on inflation earlier in this presentation. We peaked in kind of the middle of 2022 at 9% inflation, which is not sustainable by any stretch of the imagination. When you get that level of inflation, the government more or less shuts down and says, we have one focus and we have to kill it, because they know 9% inflation, let's say if it's 2, 3, 4 years, that's the stuff of Great Depressions. When things go up and stay up and keep going up at consistently high paces, that's where you kind of have anarchy a little bit. I think of Argentina's been crazy dealt with inflation. This is why you have tremendous turnover in governments in a lot of kind of South American countries. Since the middle of 2022, we've had a fairly steadily decline from about 9 to 3%, and it stayed relatively sticky at that point. So where normally the government would have lowered interest rates already because inflation has cooled, inflation has stayed relatively sticky. Now, something that doesn't normally cause this much pain is auto insurance. So as you look back at kind of history, it's normally a very silver sleeve. But I know personally, I had a 22% increase last year, which to me just sounds insane. But that's this red column right here. So you've gotten a lot of turnover with inflation. And this is also another term I'm going to introduce right now, is kind of rolling recessions. We haven't had a recession in the last 2-3 years. Everyone thought we were going to have it in 2022. It never came. The overall economy did okay, but within it, you had sleeves do poorly. So for example, during COVID, all the recessions got killed. Everyone spent huge money on renovating their homes and at-home entertainment. Then once everyone can go out, the restaurants went crazy, travel went crazy. All the people that were in the shipping industry and kind of bringing stuff to your home, all those had a minor recession just for that particular part of the market. So as we sit here today, The overall economy is okay. Overall inflation is stabilizing. Again, the Fed's targets to get us down to 2%, at which point they plan on cutting interest rates. But if unemployment starts to tick up, they'll probably do it a little bit before that. So it's still a little bit painful, a little bit higher than what we were looking for, but at somewhat reasonable levels compared to recent history. Now, this is interest rates in the bond market. So like I was just touching upon, this is the Fed funds rate. So this is the government controlling interest rates. So here we are kind of in 2022, inflation took off. So the government raised interest rates to cool the economy. So think about it. I was, give an example of, let's say you wanted to renovate your kitchen, and you would normally for the last 15 years say, I'll take a line of credit on my house. It costs me 3% and I'll pay it off over 5 years. Well, instead of 3%, it's 9%. Well, at 9, you know what? I'm going to hold off on doing the kitchen. So typically the higher interest rates go, the less investments people make in their real estate, less investments companies make in research and development because it's that much more costly. So they're kind of purposely slowing down the economy in the hopes of also slowing down inflation. As we sit here today, like I mentioned, inflation came down, but kind of plateaued a little bit above where they want it to be. So we've had a period of time where the Fed said we were going to cut rates 3 times this year. Now they're probably lowering it maybe once this year, a quarter point. But the blue here is what government thinks is going to happen. The green is what markets think are going to happen. Yeah, as the economy slows down, as the unemployment number ticks up, you're probably going to have a period of time where they're going to cut interest rates. Now, this is why when governments raise interest rates, 9 out of the last 10 times it's sent us during a recession. Only in the kind of the early 90s that they were able to raise interest rates and lower them a little bit without causing a recession. So far, we've also been able to replicate that. That's probably partially because we had that job market I was talking about before, where you had 12 million job openings for 6 million. So it's a lot of phantom jobs just went away, didn't really hurt the economy. And we've also had a situation right now that's very weird of no one moved. So you had people locked into low rates that these high interest rates didn't really hit huge percentages of the population because you were locked into low rates. So we've had a situation where the government raised interest rates right now. The economy is still going okay, hence why they kind of plateaued on interest rates. Now, this is kind of great for the savers out there. We get to walk into a bank and collect 5.25. It was 2006 was the last time we saw levels at that high. Now, something I always want people to realize, there's rate of return, kind of we'll call that nominal yield. That's the yield you see. So for example, if you see a CD offering you 5%, that's your nominal rate. And then what you might want to ask yourself is, well, what's the real rate? And so that's what this chart is going over. So this is the 10-year government bond. So at the end of the second quarter, the 10-year government bond was yielding 4.3. Say, that's not bad. Not too long ago, it was yielding 2%. So to collect 4.3 is not too shabby. But when you factor in inflation is roughly 3%, and after inflation, you're only earning about a 1% rate of return. Now it doesn't sound so good. You have money to purchase goods. That's why it exists. So over time, and especially if inflation is high, money is probably the worst place to store your wealth long term. Don't quote me on the exact percentage, but over the last 100 years, the dollar's lost roughly 96% of its value. So over the last 100 years, I didn't care if you held gold, real estate, stocks, almost anything else other than cash. Cash is fantastic. Cash for short-term purposes, next 1, 2, 3 years. But after that, you probably want to look for something that provides you a healthy, real rate of return. So, maybe you're looking for 1 or 2% above inflation. Now, you're actually getting that right now from CDs because the yield curve is inverted, which means that short-term CDs or short-term bonds are actually paying more than long-term. That typically signals a recession is coming. Typically, it says there's not a lot of faith in the economy, and it typically signals the government's going to cut interest rates soon. But for our purposes, and what I want to get across is always think about what is my return after inflation. Now, to just change gears over to the bond market, and I just want to give a little bit of example of how bonds work. And you could think of bonds just like you would think of a CD and how they work. Let's say you went into TD Bank and you bought a 10-year CD. Let's say they existed for that long a period of time. And let's say the bank offered you 5%. So you give them the $1,000, you collect your interest every year, and at the end of the 10 years, you get your money back. Bonds operate the same way, but instead of a guaranteed from a bank, let's say McDonald's or any other company is issuing a bond, they might have to offer you a little bit more than you would get from the bank because the bank is guaranteed. So let's say the bank is offering you 5, let's say McDonald's would offer you 6 because they're a really healthy company. The odds of them going bankrupt and you losing your principal is very low. So they don't have to offer you a little bit more. So we have this bond that's paying us 6% for the next 10 years, and we paid $1,000 for it. Well, let's say interest rates start to go down. Now, McDonald's issues bonds in the future, they only have to offer, let's say, 4%. Well, if you have one paying 6, yours is worth more money. So your bond has gone up in value since everyone can only get one paying 4 and you have one paying 6. So what the blue bars here represent is a 1% decline in interest rates. What happens to the value of the bonds? So the longer the term of the bond, let's say a 30-year term, you're having a big appreciation. Go back to that example. If you have a 1-2% increase above what everyone else can get, well, if you only have that increase for a year or two, that's not that big of a deal. But if you have that 1-2% increase and you've locked that in for 20 years, that's a very big deal. So the longer the term, the bigger the pop. So for all the people like, oh, I want to be in money markets and CDs and short-term bonds, I get it. But if interest rates going down, you're missing out on some appreciation in the bond market. Now, just changing gears back to the stock market a little bit. So far tonight, we've just really touched upon U.S. stocks. So U.S. stocks are trading at 21 times earnings, fairly expensive levels, and had a very big run. Now, markets tend to seesaw. There are periods and stretches of time where U.S. has outperformed versus international stocks, and of course, vice versa. So as we sit here today, we had pretty much the longest and biggest period of U.S. outperformance in history, and we're trading at pretty big multiples compared to international. So we're trading at 21 times earnings. International stocks are trading at maybe 12 to 14 times earnings. That's a really big spread when you look back at history. So you're probably looking at a period of time where international should provide a decent amount of outperformance over the next 5, 10, 15 years. This just further clarifies that point. Another example of why the outperformance, here's the dividend yield as of today comparing US and international stocks. So the S&P 500 over the last 20 years is normally giving you a dividend yield of 2.1. Well, now it's 1.4. And the reason for that is because the dividend's still okay, but the prices have gone so high, it makes the yield that much lower. International are now trading at providing a dividend of 3%. So you're getting pretty much double the dividend in international stocks compared to US. Now, this is, again, one of the staple slides that I always like to go over. There are always short periods of time that are unpredictable. And just to look at 1-year numbers, comparing a pure stock portfolio, a bond portfolio, and a 60-40 portfolio. 1 year, of course, we could feel some pain. This is why anybody has their 1-2-year money. I want pretty much no risk in those types of reality. Just try to generate some conservative interest on that type of time horizon with your money. Now, once you're going in the 5, 10, 15, 20-year scenarios, we look at 5 years, for example, and we look at a 60-40, more or less in the last 75 years, if you stayed calm, even through the financial crisis of 2008, and you just picked your head up 5 years later, you never lost money. This is the key to investing over time. Pick a risk tolerance that you feel comfortable with and stay with it in good times and bad. And if you're able to do that, and again, this was almost a 75-year period, you averaged 9+% in a 60-40. That's really, really good. Now, I don't think it's going to be that high over the next 10 years for some of the reasons I went over before. Typically, the biggest part of my clients and a lot of clients' portfolios is US stocks. US stocks are trading at 21 times earnings. So we'll probably have a little bit more muted going forward. But we luckily have a world where if we have three main categories, US stocks, international stocks, and bonds, well, bonds are paying us 5 and change. International looks relatively cheap. Even if US stocks drag their feet a little bit, our overall rate of return should be pretty good. Um, so, again, always stay calm. There's always going to be good times and bad, but leave it alone. Stocks have given you a pretty healthy rate of return over time. This is I feel a slide that I have to go over. We're in an election year. We're 5-6 months away from a presidential election. Obviously, people are tense. People are stressed out. Something I want to discuss is people like to overlap elections and presidents and who in power and exactly what's going to happen in the economy. So I already know, come closer to the election, I'm going to hear from about 15 people, hey, if so-and-so wins, I want to cash out and get out. McDonald's is going to sell cheeseburgers. Home Depot is going to sell shovels, no matter what. Again, who the president is a factor, but there's probably 25 factors that are at that level of making things important in what happens in the economy. The thing I like to say is, a president who is pro the economy might be able to take an economy from a B to a B plus. Someone who's a little bit more wanting regulations, wanting, environmentally friendly thing might take it from a B to a B minus, but it's not quite the A to an F to an A type scenario. A good example of this is the bottom of the slide. Bush did typical things that Republican might lean towards, doing tax deductions, a little bit more pro the economy. Well, his rate of return his 10 years was negative. Well, it's not quite because of him. We had a situation where he was straddling a tech bubble and a 2008 financial crisis. In the same way, Obama, he had 16% rate of return. I'm not saying good or bad anything about his politics, but a large percentage of that rate of return is simply he came into power at the bottom of the financial crisis. For the most part, anyone could have closed their eyes and the markets would have torn up. So again, I'm not saying he did a good or bad job, but a lot of times when it comes to how a president's done, they're jumping in for 4 years or 8 years. That might be in the middle of a cycle, might be the beginning of a cycle. The economy is this humongous thing that has multiple factors. What China does, what does oil spike do? What are interest rates going to do? All of these are, in my opinion, kind of equal as who is the president. So again, when it comes to your long-term investing, it's relatively noise. So again, stay calm, stay relaxed, stay disciplined, and putting all that aside, you always want to bring it back to yourself. And so right now, as I'm sitting down with clients, we're rebalancing, taking risk off the table. That's because it's real to us. Pretty much every single person on this call, in my opinion, has a winning hand, meaning they have a financial plan that allows for a lifestyle that they would enjoy for the rest of their life. If that's true, and we just had a humongous run in the stock markets, you should be taking a little bit of risk off the table, regardless of who you think is going to win, just because it's a good time to do it with markets being high. In saying that, I do want to thank everyone for joining us tonight. If you have any questions, feel free to write in the chat box. Or, of course, always shoot me an email if you want to have more of a one-on-one type session. Okay. Well, again, thank you so much for coming. I am always here. I really thank you for joining in. I know it's kind of late, so I do appreciate it.